Hello, welcome back to Connected Farmer. Today, Michael Zuzolo is back to our program to talk about the heat wave and its impact on the commodity markets and the support that came to wheat in the markets from the weaker US dollar. Everything to you'll see here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget subscribe. So Mike, how are you today? So wheat has found support as you forecasted last week.
Yeah, that's mainly due to the dollar finding a top as we closed out last week and came into this week, Luis. Some things changed with the dollar. I think one thing was the COVID fears are subsiding a little bit. I wouldn't be surprised to see those return, however, especially with the Federal Reserve going into their big symposium in Jackson Hole, Wyoming at the end of this week. And so the dollar has found some resistance. It's pulled back some. I don't think as we oftentimes say, we're not out of the woods yet when it comes to the dollar and the macro conditions fighting us and pushing us down. It was pretty clear when we had the dollar going higher. The crude oil, the copper, the soybeans, the unleaded gasoline, these were all leaders to the downside, and that was pushing on the wheat as well. And all the while, the European wheat market was rallying. And I want to say that the futures market in Paris is trading around $8.60 a bushel right now, converted to US dollars. And that's a full dollar plus below where we're at right now in the Chicago Board of Trade, Chicago Mercantile Exchange. But yeah, going back to the wheat and finding support first, that was very necessary because of that macro influence that we have. I'll feel a lot better after Friday afternoon and get a feel for what the Federal Reserve is looking at and what they may do after their Jackson Hole symposium at the end of the week.
Yes, and jumping into the heat wave in the central parts of the USA, I would like to learn from you what's the impact this will have on the corn and soybean markets.
Yeah, that's a really good question, a very timely question. I do think that the trade on Tuesday was able to find a little bit of extra support in the soy complex for a variety of reasons: crude oil, soybean oil, soy meal, and India coming in and allowing 1.2 million tons of soy meal imports of GMO soy meal to curb their feed prices, which in some areas and in some types of feed, their prices are triple what they were a year ago. All these things, plus the crop conditions in this heat, I think really helped bring the beans back up and get them back above the June lows. And that was an important level because, technically speaking, given the weather pattern we've had and given what USDA gave us on the supply demand report not much more than a week ago, I didn't think we should take out that 1320, 1325 level in the June lows in the lead month soybeans, but we did, and we did in a big way, in part because of what we talked about just a little bit ago with the overall macro forces and the energies working against the soybean oil and working against the Chinese in terms of the COVID outbreaks and the Qingdao port being shut down for 2 weeks, which that's now operational again. That I think that really made the trade very, very nervous. But what I'm seeing right now is what the crop conditions is showing. And that is the fact that we're at 56% good to excellent in soybeans right now. That was down another point versus last week. And more importantly, it compares to 69% a year ago. And recall, a year ago, we had a 50.2 bushel national yield. So I think we are below the 50 bushel level at this point. I just had in both the states of Ohio and Indiana, two very big states for production potential this year. Clients call me within the last 24 hours and tell me that they are losing yield by the day. which surprised me very much because I was under the impression they had been cooler and wetter than what we were. But I think what they're looking at is a record yield slip out of their hands. And that was the comment from the Ohio producer in particular, was that he thought that he would have corn and bean yields as good, if not better than 2014, which was his personal record yield high that year. But now he's thinking it's not going to happen, especially if they miss another few days of rains and it turns off hot. Western Corn Belt is even worse. When back over here, we're one of only four states in the country right now where the good to excellent conditions for soybeans is below 60%. Kansas now joins Minnesota, South Dakota, and North Dakota. We've lost a lot of yield potential, in my opinion, in the heart of the corn and bean belt in the state of Kansas the last week or so. We've lost a lot of corn yield potential too in the form of lower test weights. I think that's where we're going to lose a lot between the tip back on the ear and test weights. And I think Pro Farmers Tour, by the pictures I saw in the Western Corn Belt, you saw a lot more heavy dough and dense stage corn than what you saw back east.
Yes, and then on the corn side of things, I would like to add that the harvest of the second corn crop is going on in the state of Paraná, and at this time they can already confirm that this was the worst corn crop ever. And in the meantime, the summer corn crop in the state of Rio Grande do Sul is being planted right now before than earlier than usual because the weather has helped.
The interesting thing about the corn market right now, and the charts depict this, is we still have a gap above the market from mid-July when the July futures went off the board. That gap is up around 680 a bushel. That's not far from where the cash market is trading in this country right now, around 620, 640, and some ethanol plants are bidding closer to that 650 to 680 level, or at least last time I looked, they were. And so you have this big gap in the charts, but yet you don't have the cash market moving higher. In fact, you have end users kind of pulling back, and river basis levels, especially at the export market, have been falling backwards. And so you have what we have going on in our fields right now. You talk about Paraná, and then I've been reading recently that the ethanol situation in Brazil is getting dire at this stage because of the sugar crop essentially being hit by terrible weather, both in terms of dry and extremely cold weather. You would think that all these things, when it comes to the ethanol and the corn supplies, that the corn would be the leader to the upside. But I think my explanation would be, other than the wheat market not allowing for that to happen, probably the more important feature to this market right now is the ethanol policy that we have here in our country, and the news that broke late last week about the EPA, the Environmental Protection Agency, coming out and suggesting that we take down the blending requirements to or back down to COVID levels of 2020 as opposed to pre-COVID levels of 2019. And we don't know if that's an actual letter or not yet, but it was a big enough issue that Senator Grassley, who's kind of our main ethanol watchdog in Washington, he made a very strong statement last week about how the EPA, if this letter is correct, would be a huge win and a huge bone for big oil. And I think that's really worked against the trade psychology in the corn market. And I'm real eager to see whether, when we get to the delivery process of September futures, which is just next week, whether that cash market doesn't ignite a little bit more and the futures market follows.
Yes, and getting back into the heat wave, why do you think there should be a rally for the cattle markets?
Well, this is a little bit different for the cattle market in terms of it is partially related to the heat wave, but it's also related to the extremely strong uh, break-even profitable margins that the meat packers have right now. We're hitting almost $1,000 a head in profit, expected profit, and that's from Hedger's Edge. They keep track of this every day, and that's just a remarkable amount of profit. Compare that to roughly $30 a head right now for hogs, Luis. And so I think you're finally starting to see some of the higher prices for the producers transfer and get put into the prices at the producer level because of these margins, and the packers are finally bidding up. But I think the key to why this is finally happening now does relate somewhat to the weather. As we were thinking, I was part of this group, that we would see a lot of liquidation pressure in the cattle market, especially in the northern plains and in Montana, Wyoming, the Dakotas, you name it, anything north of I-90, you would have liquidation pressure. But what we're seeing instead in the cattle on feed report just this past Friday, once again, kind of magnified this, is that we don't have a lot of on feed numbers. We don't have, I don't think, as much as we thought we did. And that's really helped the cattle market quite a bit, and helped the packers come in and bid up the cattle market. Having said that, I just put out a recommendation again today to clients and subscribers for catch-up sales in the feeder cattle market as the August goes off the board, about $2 discount to the CME cash index. The September feeders take over as lead month with almost a $10 premium. And so you're talking about a $12 premium with September futures against the cash index coming into next week. So I think you've got a really good profitable level in the feeders. And if the corn market does decide to jump, I think the feeder longs will jump out of their positions.
And what about the beef market? The beef producers should wait more?
Yeah, the live cattle producers, I've got them on kind of standby to get hedges in place. One of the most interesting things about this past year has been year to date, our livestock slaughter is down about 0.3% year to date. Adding both cattle and hogs together, we haven't been able to get up to last year's levels, which is saying something given the pandemic, and given that we probably had a lot of shortfall at times last year because of the pandemic. And so we see that reduction in slaughter year to date for cattle and hogs, but yet the hog market, the cash hog market's up 152% versus where it was a year ago today. And yet the cash cattle market is only up about 17 or 18% from last year at this time. So I'm giving the cattle market a little bit more room to hit some technical objectives, test those technical objectives, and wait for a similar sell signal on the oscillators that I'm seeing in the feeders right now.
All right, Mike, anything else to add?
I would say to you, Luis, the biggest thing coming up is going to be the Federal Reserve. I don't think the Fed's worried about inflation because as much as they are about the financial markets, because they have COVID-19 kind of a natural break on the inflation in terms of the demand side of the equation. So I think what we'll hear out of the Federal Reserve at the Jackson Hole meeting this week is ways to start tapering and pull back their asset purchases. If they do that, we'll have to watch those interest rates very, very closely, because that could once again attract the dollar to a higher price level if those interest rates go up too quickly. So it's very tenuous and still very, very much an issue in those macro conditions right now.
Thank you, sir.
Thank you, Luis. Have a good week.